June 22nd, year 2019. This is Mijanur Rahman from Toronto. This is the Financial Planning Tacit Knowledge Series. This is the second series, and today's topic is the video number for this is video number. Let's keep this a video number 12. Now I know the video number 9, 10, and 11, 9 part 2, 10, video number 10, and video number 11. I wasn't able to publish those videos, but they were somehow, I believe they were missing from my Nokia device. But anyway, so today this video is slightly different in nature because I wanted to demonstrate, and also this video requires me to access the internet while I'm producing this video number 12, Financial Planning Tacit Knowledge Series, because today I would be using NASDAQ, their website, and I may be able to obtain some of their data from their from the company, so that you can also share those website with you, so you can actually get more information. You can familiarize with that particular website when it comes to IPOs, SPOs on the primary market and secondary market. Now, the secondary market and primary market, you probably have the ideas now. In a primary market, the benefit, the proceed goes to from the shares goes to the issuing company, and the secondary market, the proceed from the sale of shares goes to the owner of the shares. So in this case, whoever the owner is. So without further delay, so let's this video will talk about the IPOs and SPOs. I know previous videos I wanted to talk in the video number 11. I briefly started to talk about the IPOs and SPOs. Now, SPOs are often issued on the primary market as well. Now, not to be confused with the secondary public offerings with the secondary market. Secondary market is different. It's a platform or where the stocks are trading. Secondary public offerings is that the initial public. It's like, okay, so if you have the company had let's say, for example, 10 million outstanding shares, and out of that they issued on the very first time 5 million shares. They sold to the public or in the market through the primary market or the now they have another 5 million shares outstanding, and they saw that now they raised, let's assume that with that 5 million shares, they sold, let's say, for example, $1 per share. And so now if they have $5 million in their hand, less the expenses that incurred. Let's assume that they incurred roughly about let's say $300,000 or $500,000. Let's assume in this case $300,000 to get those financing costs, the underwriting and the auditing and so forth. And you'd have to excuse me. I remember I was telling you on my video number 11 I was dealing with some health issues, and for some reason, when it's giving me problems with the speech, and also it somehow I felt the I don't know if there's a lack of oxygen or something where I'm producing this video from. It actually gives me yawning vibe, but you'd have to excuse me if at any point if you feel the sound of my voice is not clear or tiredness. You'd have to excuse me for that. But anyway, let's continue with the so this video, like I said, this video will be different in nature because I would be surfing the website, the NASDAQ website, where the IPOs and SPOs are listed. You could go to any other, also other stock exchange where they should the where they have the ability to sell and trade IPOs in the market or SPOs. Anyway, excuse me. So by the way, it's also about 1:30 a.m. in the morning as well. So now the company had another 5 million. Out of that 5 million share, they had another. So now assuming that the secondary offerings, secondary public offerings. So let's continue with the video number 11. Where we left off is that the company had 10 million shares after that was authorized authorized the articles of incorporation, and then they issued 5 million shares on the IPOs. Now they have another 5 million they can issue on the secondary public offerings. So now the issuance of secondary public offerings will reduce the value, and this is much more market psychological than a mathematical or logical, because think of this way: the supply here actually went high. Now this is where the economics comes in. The supply here, the supply of the stocks are getting higher than probably the demand. So because of that, now the company needs money, and they need to raise money, and therefore they need to, and because of the circumstances, they need further more money to finalize their project, or they've continued their projects, or continue with whatever the plan they had. So initially they probably miscalculated, or something happened with their project, or projections, or something, because of the global changes, because of the political unrest, whatever the reason is. A lot of things, many things in this universe we don't have control over. So this can happen to anyone, any company. It is very normal. And so now they would have to find more financing from the public market. So as a result, they will be issuing more shares. They'll sell more shares to the public from the primary market. Now, because the primary market, because the proceeds actually goes to the proceeds from this goes to the as you can see, it goes to the issuing company of the shares, the issuing company of the seller of the shares, right? So because of that, it still trades on the primary market, and the proceed goes to the financing. The financee in this case, the company or the corporation. In our case, it was ABC Corporation. Now, this ABC Corporation now they decided to issue another let's say another 5 million shares, the secondary, which is the SPOs, or maybe you could say perhaps you could say instead of 5 million, maybe you could say 4 million, so that you don't get confused. So now the second time on this secondary public offering, they decided to issue another $4 million. Now the first time they were selling share for $1 each. Now the market value, assuming that the remaining dollar, for some reason it didn't, the price of the share didn't really go up or down, probably, or it's still trading at $1. Or maybe the changes are very negligible. Maybe it's with about 5% or 10% up or down, or 20% within the range. But whatever it is, so the price hasn't gone up significantly. The market value of the shares, or the trading value in the market, are not significantly different from the book value of the shares. So in this case, the book value was $1 at the very beginning, the issue at the time of issuance of the shares. So now on the secondary offerings, now obviously the supply curve, now this is where the economics comes in very handy, because of the supply is very the supply is more. So what happens when the supply is more, the demand is, because the demand may or may have been changed or not, but it will affect the but it will affect but it will affect the pricing of that stock because of the market psychology, because of the our thinking. Because you always remember I said everyone in this universe, they want to buy low, sell high. So let's say, for example, if you go to market, to buy your grocery, you want to buy things at a cheaper cost. When I was a kid, I had to buy, I had to do the grocery for myself. I used to do the grocery for us, and I used to go to the market for shopping, and I remember, at always the intention of buying at always at a lower cost. So whether it's me, whether it's you, whether it's anyone in this universe, the intention, whether it's $1 billion buy, whether it's $1 billion buy, whether it's a $1 buy, whether it's a candy, whether it could be cotton candy, or it could be anything. The intention, or it could be a pair of shoes or ties or a shirt. Even though we don't have resource scarcity, our intent, because we want to win, because as a human in nature, we always want to win. We always want to hold up the upper end of the bargain, and because of that psychology, we will always want to buy at a lower cost, unless the person has a significant difference, or he or she is an outlier. Then only then they will probably pay a higher cost, or they didn't understand it, or there was a problem with the information they received. So now the company can no longer sell the shares at $1, even though they put it up. The demand will be a lot lesser. So as you can see, the answer is right here. Because the value didn't change in the market from $1 to maybe change between it probably traded between 1 to 10% high or low, and the market price hasn't really gone up so much. Maybe let's assume the second offerings was done within 6 months time period. So because of that timing and so forth, it could be other reason. Now let's not speculate. Usually the market value goes up or down, but for our example, I want to keep this very simple and simplified. So now they can no longer sell the new issuance, the issuance of secondary public offerings at $1. So they would have to come up with some sort of discount, because the demand is low, the supply is higher, another 4 million shares to sell to finance their project. So now they'll probably discount it. They'll discount the share. Now you would also have to remember something. Often there might be some sort of clause if they have a debt issuance, if they have a debt equity covenant, or they also might to retain to retain or keep control of the company. Often they might have some sort of conditions with the past issuance of the IPOs or something, that they would have the existing shareholders would have first rights of refusal, meaning is that they can choose. So they would be given the rights to buy the any of the shares the company that comes out, and they can exercise their rights, or they can simply let it expire. So if they don't decide to pursue their rights, then it would be out of frustration, the rights would expire. So the both party would be, free to sell. Especially the financee would be free to sell the stock, the second issuance, which is the secondary public offerings or SPOs, to the public. Now, see, the fact here is, the interesting part is that because our demand went down, now we can no longer sell that share for $1 because of the market psychology, because of the market behavior, because of the economic condition, because of the supply and demands, because of our nature, our human qualities. We want to, because of all those reasons, it will no longer sell at an equilibrium condition, or at a market value, or at an equilibrium market price, which is, let's assume that was the $1 also. So it won't sell at that price. By force, they would have to discount that probably by 10% or 20%. So now let's assume in our case, so this next 4 million shares, they would sell that at 80 cents per share, right? So at 80 cents, so the 4 million shares, so rather than having 4 million in their pocket, now they're at a loss of $200,000. Not loss, because that's the cost of the financing, if you really look at that, because they had to drop the price to sell that another 4 million shares to obtain the 3.8 million dollar of new financing. So now they have 3.8 million, which is, I believe, if I'm not, I don't have a calculator in front of me. Maybe I could try to see. If you bear with me for a second, maybe I should be able to go into my calculator here and see if I could, whether I have a calculator in this. Okay, there it is. Okay, so we have 4 million shares trading at 0.8 cents. So that is actually I was incorrect. So it is 3.2 million they would be receiving. So they would be receiving 800,000 less. So now obviously, as you can see, so now the combine, they would gain 3.2 million plus 4 million from before. That's about 7.2 million. So they raised 7.2 million capital from the equity market, from the public financing. So the cost, now let's assume that the first time the cost was the underwriting cost, and all the other costs to get everything done was $300,000, and now the new cost is, let's assume that another $200,000. Now there's a $500,000, $500,000 cost, then cure to raise $7.2 million. Now the cost of $500,000 to raise $7.2 million is actually high. Usually, in a company like this, you would see that they would probably issue more shares, 10 millions, 20 millions. But for our examples, I want to, for you to not to get confused. So let's not get confused the other side. So the cost of the financing is actually higher in this case, and also they had to reduce the cost of the value of the shares to 800,000. So instead of raising $8 million, they actually raised $7.2 million. So they have a lot. They have a how do I say this? Because the less demand in the market and the more supplies, they had to discount those shares and the second offerings for $800,000. Now the cost of these shares, the book value of the share, the average book value of the shares would be different. And now, at the very time it was $1 at the initial public offerings. Now this will change. Let's see if I could get that calculator working. It's actually, let's see. while I'm talking to you, I'm actually calculating this on my device to so 7.2 million divided by, so we issued 5 million and 4 million, 9 million shares. Okay, I don't know if I'm making a mistake somewhere here. It shouldn't be that, because the first one was the, let's clear this off. So we know for sure that we raised 4 million at the very beginning, and then we raised 3.2 million, that's 7.2 million. So the total share standing is 5 million plus 4 million, 9 million shares. So 9 million shares divided by $7.2 million divided by 9 million shares outstanding, that should be the cost, the average cost of the shares. But for some reason, I think I have a difficulty of getting this here, but you'd have to, so you'd have to, the book value of the shares will go down because of the discount on the second time. Maybe next time I'll probably have this ready, but again, I didn't, while I'm speaking to you, I didn't prepare anything, so none of those video series there. I'm speaking as there was no preparation whatsoever. I just sit down, make few notes so that I can speak. Okay, so now the condition was, I mentioned that why and under what circumstances the company would issue secondary public offerings. So the shortage of the financing could be many other reasons. One of them is that. The second is that they have the difference from, they also talked about how IPOs is different from the SPOs. The difference is because this is the second time they're offering it. This is not the first offerings, and because of the various reason, they actually contain the discounted price, and the other than that, everything is very similar, and they're also traded on the primary market. And the third question was are there any competitive or financial incentive issuing the SPOs than IPOs? Well, basically, you'd have to, there are always pros and cons of new financing. Every time you finance something from the public market, you would have to pay the cost. You would incur cost. This cost could be legal cost, accounting cost, auditing cost, what is it? The other costs. So there are various costs that will build into this financing mechanism, right? So the fact is that you want to finance at the very, so when you issue IPOs, you want to make sure that the project you're financing or the money you need, actually you kind of finance slightly more than what you need, and you could probably put into a contra account. There's a legal name for it. I forgot the name. You'd have to excuse me. The money that you are not using, I forgot the name for it. Wow, it's been quite some time, so you'd have to excuse me. It's some sort of often lawyers use that for it's like a trust account, but you could keep it there, or you could just simply utilize it. But you could keep them. Financing is done, so you might as well use the money. So they have the option to how to hold this new capital in the financial in their balance sheet, what rules to apply. But usually, once the financing are obtained, they goes to the equity part of the balance sheet on the equity section. Now, depending on the type, depending on the condition, depending on the legal obligations, they might take different forms, and they might be accounted, or you might see them in a different type of you might see them in a different accounts, different name, and so forth. So it could be share A, share B, share C, share D, or it could be preferred share. It could be and then some. So this kind of things that you'll see. And I'd have to take a look into the whatever the fund that is needed, don't need. I think there is they follow certain mechanism, they follow certain rules on that. Some company, I think, they probably, if they don't use the asset, I think you'd have to, I would have to take a look into that. You'd have to excuse me on that. So again, so let's get back to this. The conversation is that so yes, there are benefits if you can estimate how much money you need to finalize your project and get things going. So the IPO, issuing one-time shares for one particular project, would be a best option. If it is a different project, then you might issue an SPOs because you didn't know. But for the same particular project, if you go twice in the market to finance your project, it's not cost effective. But often companies, they expand in different market, and they go through the secondary public offerings, or they go to the OTC to finance their project. So that's how you see. This is how you find out whether there's a competitive advantage of issuing SPOs or IPOs. It's always the best option to get IPOs, financing done at once. Your cost would be a lot lesser than issuing more, because regardless, the legal bills will appear. Regardless, accounting and auditing has to be done. Regardless, the regulations would like to see all the details. So. And again, because of the time gap, 2 quarters is actually a lot. So maybe often probably there might be certain standard or guideline whether they can use the same information or not. But if it is a 2 quarter past, they most likely they would want to see some new documents from the company. So the cost of this is issuing secondary public offerings will be higher. Again, if it is after the one fiscal year, then obviously you're for sure that you're going to need all those new sets of cost, new sets of information, all those consolidated data, and all those so forth. So it's a good idea to get things done at once, issue the IPOs, finalize your project, get things going, and then you could continue with your operations. So the second things I want to talk to you, actually, this is the fourth things I think that I want to talk to you about, is that I already talked to you about the dilution. Because of the dilution happened, so it was, in our case, it was the first time the company issued the IPOs, it was $1, and the second time they issued the SPOs, it was 80 cents. So it would be easier for me to I don't have a calculator here, but I think so the cost now it no longer be, it's probably be, I think, if I'm not mistaken, so the cost for this 80 cents for 4 million shares, and the other one is, so you'd have to divide that, the amount of money you raised, 7.2 million, divided by the total shares that is issued, which is 9 million. So this is how you actually come to the average cost of the book value of the shares, right? So yes, the dilution happens because of this. Now the dilution of the stock value occurred to the existing shareholders, unless they are unless they are given some sort of rights to exercise that at a set price or something like that. But regardless, the dilution will happen because of the market demand and psychology. Market say it is highly likely you see a dilution. Then the second, I think I'm always hung up with I'm always with second notes anyway. Was the next thing I'm going to talk to you about is that okay, so let's get back to I took some snapshot of the company on the NASDAQ. Let's see if I could get them up here. Oh, there it is. Okay. Oh, it's taking me directly to the NASDAQ, their website. So let's see. Okay, so now we're on the NASDAQ.com, and the website is called. If you actually Google it, you'll probably get it. It's easier for you to Google it. So you go to NASDAQ.com/markets and SPOS, I guess, and then that will take you to that website. So the secondary public offerings, you'll see, you would have once you go to their website, you'll see the recent IPOs pricing, and then you'll see the recently failed SPOs, actually not IPOs, SPOs. Same thing with the IPOs, it's no difference, okay? Then you'll see the recently withdrawn SPOs. So this can happen for the regulatory, either they failed or either something happened or their decision, the change in they have a different heart, they change their mind. So if you click on one of these, as I'm talking to you, so here on my screen I have the Quick Logic Corporation, and that is the recent SPO pricings, and if you click on that, you'll see that the acronym for that is the QUIK, and that is it shows 50 cents. Let's click on that. Let's see if it takes me to that. Okay, let's wait and see if it takes me. Oh, there you go. Okay, so. And the stock card, it shows various information. I'm going to actually pick this video device up so you can see clearly. Excuse me. So the first thing you'd see if you go to as I'm talking to you, you could pause the video and you could go to NASDAQ and type on the Google the SPOs NASDAQ. So it will take you there, and then you could see. It could be any company, it doesn't have to be. You'll see the recent information, the recent IPOs pricing. You pick any company from there, you'll see the company name, and you'll see the address, you'll see their website, you'll see the company information, you'll see the CEO's name. Often it's a good idea to research these CEOs, whether they have the experience and the operations, whether they have the knowledge or expertise, because you don't want to find yourself in a different dilemma. Then how many employees they have, whether is it so let's say what kind of business they're into. Are these qualified employees? Are these skilled employees? Or that they're labor? Or what kind of business they're in? Manufacturing? What kind of things they're offering? Then you'll see the state where they are actually home company